The extreme inflation spikes of 2022 are firmly in the rearview mirror. But as we move into 2026, the anticipated return to an era of cheap, easily accessible money remains elusive. Right now, there is a massive disconnect in the market. Investors have optimistically priced in 2 to 3 aggressive interest rate cuts this year. Compare the steep downward curve of market expectations against the Fed's flatter, gradual projections. Two completely different realities. The Fed is trapped in a tight balancing act. Core PCE inflation hovers between 2.4 and 2.7%, while unemployment sits resiliently between 4.4 and 4.6%. That not too hot, not too cold data leaves Federal Reserve Chair Jerome Powell walking a very thin tightrope. Trying to blindly guess his next move is a quick way to mismanage your portfolio. To successfully navigate 2026, you have to abandon market assumptions and look at the exact decision tree the Fed relies on. Inside the Federal Reserve, policy isn't based on intuition. It is a highly systematic, strictly data-driven methodology. This chart shows the underlying architecture of their strategy. Every choice they make stems from a single decision tree, and that tree is fed by 4 distinct streams of economic data. The first stream tracks inflation trends. Core inflation has been sticky, especially in shelter and services. The Fed weighs those ongoing costs against upside risks from new tariffs and fluctuating energy prices. The second input is labor market conditions. The unemployment rate has risen modestly, but remains relatively low. If job losses accelerate and cross the SOM rule threshold, a historical indicator of early recessions, the Fed will pivot quickly to support employment. The third input is economic growth. Strong corporate investment and AI-driven productivity gains are actively supporting growth, but they are weighed against the continuous risks of consumer spending slowdowns and geopolitical friction. Finally, they monitor overall financial conditions. If stock valuations stay high, credit spreads remain tight, and borrowing costs drop too quickly, the Fed may push back to prevent the markets from overheating. Because these 4 macroeconomic inputs constantly fluctuate and frequently contradict each other, a straight path for easing policy is mathematically impossible. The data forces the Fed to prepare for multiple distinct scenarios. Depending on how those 4 data streams shift in real time, the Fed's algorithms combine them to generate 3 primary policy paths for the rest of 2026. Look at this first projection, the Dovish path. If inflation glides smoothly toward 2%, growth slows moderately, and the labor market remains stable, the Fed delivers 2 to 3 quarter-point rate cuts. But if energy shocks, strong tariffs, or wage pressures trigger an unexpected resurgence in inflation, we hit the hawkish surprise. Here, the Fed stays on hold with 0 cuts, or even signals tighter policy. The third possibility is the cautious path. If inflation stays sticky around 2.5%, while growth surprises to the upside, the Fed holds rates steady for longer and delivers only 1 cut, or pauses entirely. Market expectations are currently skewed heavily toward that first scenario. By pricing in those 2 to 3 cuts early, investors have essentially bet everything on the most optimistic outcome, leaving little room for error if the Fed stays cautious. While 3 scenarios are possible, many Fed watchers see a middle path as the most likely, exactly 2 rate cuts spread across the year. This outcome reconciles a labor market that is cooling just enough to allow easing, with an inflation rate that is still too sticky for a major cutting cycle. This environment is higher for longer light, a sustained departure from the ultra-low interest rates that defined the 2010s. This chart breaks down the direct impact on your money. On the left side, modest rate cuts provide support for growth and AI-related equities, though volatility remains high. On the right, falling yields create immediate capital gains for existing bondholders. For borrowers, mortgage rates will ease slightly, but they will likely stay elevated compared to the pre-2022 era, keeping steady pressure on housing affordability and corporate borrowing costs. And if you rely on high-yield savings accounts or certificates of deposit, those idle cash reserves will begin to see gradually lower returns. To track whether the Fed is sticking to this baseline or shifting to a different scenario, you need to monitor 3 specific indicators: monthly core PCE inflation readings, labor market data like jobless claims, and the tone Chair Powell takes in his press conferences. Managing a portfolio in 2026 requires moving beyond a static forecast. It demands a process of continuous recalibration as each new data point updates the decision tree.
I hope you liked this video. Don't forget to like and subscribe.